Good day, everyone. I welcome you to the third lecture of Mod 3 when we're talking about institutional sponsorship. This is going to be a follow-up to the previous lecture that was released. Now, what we're going to be learning in this lecture is how to identify setups using the institutional order flow. And there are four things basically you need. Number one is the higher time frame displacement. This could either be a reversal, expansion, or return to fair value. Then the second component you need is intermediate term imbalance and or paired with a break of structure to the upside. This is when an immediate term imbalance is created after an expansion to the upside. After this occur, what you should expect is to see price move to discount or take out liquidity before running upwards. The third component is your target. A good quality of a professional and profitable trader is knowing where to enter and where to come out of a trade before placing the trade, where to enter and where to come out. And where to come out has to do with two places, your stop loss and your target. So you have to have a stop loss and a target before placing the trade. So the third thing now for identifying long setups using the institutional order flow is the target. And then this will be placed in short-term highs where you want to pair shorts to sell to. Then the lastly is the time of the day, which are called ICTQ zones. I'm going to be explaining ICTQ zones in the next lecture that will follow this lecture. These are just time windows for executing your trades. Now, this is just the reverse for a short setup. The four things you need is number one, the high time frame displacement. Like I said before, you want to get your trade ideas from the higher time frame. Don't dwell on the lower time frame. The higher time frame is where the banks move, like the daily, the weekly, the monthly. That is what the big bank use to take trades. So we want to be getting our bias from the higher time frame. So the first thing you want to see is you want to go to the higher time frame. Now, remember I explained that as a professional trader, you have to have at least 3 time frames: the higher time frame, intermediate, and then the lower time frame. So these 3 time frames, you want to go to the highest time frame and then look for price displacement, which could either be a reversal, an expansion, or a return to fair value. And the second component is an intermediate term imbalance and or paired with a break of structure to the downside. Now, you can see and unpaired. There must not be a break of structure, but what you want to see is that creation of an imbalance. Once that imbalance is created, you want to wait for a move of price to the premium or take out buy-side liquidity above the market. And then the third, you want to identify your target, which will be seen in the short-term lows, where you will find sell-side liquidity, which is below the market, for you to pair your short exit to buy to. You are coming out from a short trade or a sell trade, you'll be buying to come out. And then lastly is the time of the day, which is called the ICTQ zones. These are windows where you want to take your trades. So now let's look at an example. All right, this is a chart. We can see that price created a range, this low to this high. Price created a range. And then if you draw your Fibonacci, this point here will be the equilibrium. Here, the midpoint of this range, high and low. So this is premium and this is discount. So you can see how price ran down to take out liquidity below these lows, these relatively equal lows here in a discount. So now price has taken out liquidity. We expect this to be a reversal. So we see price has displaced. So this is the first thing we are looking for. And this is a higher time frame. This is a daily time frame. So we can see price displacement to the downside to take out liquidity. We are expecting this to be a reversal. So we want to see price run up to take out this high. So like I said before, you want to pair with break of structure. Break of structure helps solidify your trade idea. So once price moves to break the structure, we get the second. So just like I explained before, this low has been tagged, liquidity has been taken. Now we're expecting price to run to break this high to the upside. So we've gotten the second component here, which is a creation of intermediate price imbalance. Price imbalance has been created. So what we want to wait for is a run down into discount, because the range has been created here. We have this low and this high. So either it takes liquidity below the market, or it runs into the discount. And you can see something here. From this low to this high, there's something here. Can you see these down close candles? This is a bullish order block. So we want to pair a bullish order block with an expansion. You can remember from the first video from 1, 2, element of trade setup. So after an expansion, you want to pair it with what? Another block. So what we expect now is that we want to see price come back down to discount, because this low and this high has created a range. If you draw your fib, here will be the equilibrium, here is the discount, and here is the premium. So we expect price to go back to discount, which will create the second component for a long setup using the institutional order flow. So we're expecting price to come back down to discount or take out liquidity, sell side liquidity. So let me go back and show you. So the intermediate term imbalance, once it has been created, we want to see price move to discount or take out sell side liquidity. So if you look down closely, you will see that this low here is the liquidity, and then this point here is the discount. So let's look at it closely. So we can see here this low here is a short-term low. So price came to take out liquidity below the market and also ran down into discount, finding support where? This bullish order block. So now we've gotten our two components, which is what? Displacements in the higher time frame and the intermediate term imbalance, and or paired with break of structure to the upside. So we've gotten the two. So for the second component, there must not be a break of structure, but a break of structure helps solidify your trade idea. And here you can see that we've got a break of structure. Price has around liquidity below the market and broken structure to the upside. We don't expect price to come back down and then take this low again, because why? Liquidity has been taken here. There's no need for market to come back down to take liquidity. So now, after getting those two components, the next thing we want to get is the target. Now, if you take a trade here, where would you want to come out? Where would you want to take your profits? Above short-term highs. So this is a short-term high here, here, and then ultimately here. So there's buy-side liquidity at this point, and then buy-side liquidity at this point. So above short-term highs, you want to be pairing your longs to sell to. You want to be selling to people who are buyers. Why are they buyers? Because their sell stops above this high. And you know when they are coming out of the trade, they are buying. So you want to pair your longs to buyers in the market. When you are coming out of the trade, you are selling to buyers. These are the dumb money. And when you find your liquidity to come out of, you find it in short-term highs for long trades. This is a long setup. So we've gotten four things. First of all, we want to see displacement. This displacement here is a reversal. Look at how price rejected immediately. And we say reversal is the sudden change of price direction. So price was going down, took out liquidity, and then rejected immediately. So for a confirmation, we want to see the second component, which is a displacement to the upside to break structure and the creation of impaired imbalance, which was created by this displacement here, and or paired with a break of structure. So we must not see a break of structure, but a break of structure helps solidify your idea. Then we want to see price return back to premium or take sell side liquidity. After that, we'll determine where we will coming out of the trade, which is short-term highs, where we will pair our longs to sell to. So at this point, we've achieved three components for a long setup. And look at how the trade ride beautifully. The first short-term high was tagged, and the second short-term high was tagged. So the next thing, which is the last thing we're looking for before taking this trade, is when to take this trade. And this time window is called ICTQ zone. Now, I did not explain it in this lecture, but the next video that will be released is going to be talking about the ICTQ zone. Now, the first component, which is a reversal, we can see here that this is a reversal. You can see how the candle rejected before creating an immediate term imbalance. Then we're expecting price to run down to discount or take out liquidity. Now, the moment price hits this bullish order block, the institutional order flow is bullish. Now, we would expect that every down close candle should hold price as price rallies upwards. Now, what is institutional order flow? Remember, I told you, it is the handwriting of institutional traders seeing a price movement as it seeks liquidity. As price begins to move or gravitate to these highs, we want to see institutional support levels holding price from going lower. So you can see how this order block held this price and then price rallied upwards. Now we can see another order block here. Look at how price found support before rallying. Now what's this? Another order block. And look at how price found support before rallying. And then what can you find in between these two candles? The high of this candle and the low of this candle. Fair value gap. As soon as price filled it, price what? Rallied. Now what's this here? Consecutively down close candle. Another order block. Price broke structure to this upside, came down, found support in this bullish order block before rallying. Price came back down again to this bullish order block to reclaim it before taking the liquidity above these highs. This is how you find setups. This is how you know the institutional order flow. You go down to a higher time frame and then you want to see liquidity at the opposing side. What you can see here is liquidity, this high, relatively equal highs, and this short-term high here is liquidity. And then we can see that price broke structure to the upside, finding support in this bullish order block. The institutional order flow is bullish. So if you go down to a lower time frame, this huge move that you see here, we would find order block, fair value gap, breakers for price to find support. Now you can see that this candle here is also a breaker. Look at how price came back down. This is a daily time frame. So if you go down to a 1 hour time frame, 4 hour time frame, 15 minutes time frame, you should expect every other block to hold. And if another block does not hold, you go to a higher time frame to look for the other block to hold price or fair value gap or breaker. Because if another block does not hold in a smaller time frame, definitely the price is gravitating to another block in the higher time frame. And what you want to see the opposing sides give way. So you can see that this is another block here. It's a bearish order block. And you can see how price give way. Tell you that institutional order flow is bullish. So every bearish institutional resistance level will always give way. And you can see as well, this here is a breaker. This breaker as well gave way. It functioned here to ride price downward. Could go down to a lower time frame. You see the significance of this candle here serving as a breaker, as a bearish breaker. So price rallied up, retraced, rallied up, and then broke structure to the downside after taking liquidity above the market and then returned back to this down close candle here, this bearish breaker before rallying downwards. But once the institutional order flow changed, what happened? This breaker could no longer hold price anymore. The buying they did there was unwinded here. So you can see this happening here. Price is not random. But let's go down to a lower time frame in the chart and I will reveal something to you all. So this is the same chart, but a 30-minute time frame. So the period was in a daily time frame, but here is a 30-minute time frame. This is New Zealand USD. Now, at this point here, moment price hits this order block, the order flow becomes bullish. So now, we know that order flow is bullish as price seeks liquidity above the market. So here is the first buy side liquidity. I think I should zoom it out so that we can see it. You can see that previous high we saw, and then the relatively equal highs here. So now, so let's zoom in. From this point here, as market hits the order block, we know that market institutional order flow is bullish. Now you can remember I explained something about market open. And we use the New York 12 a.m. midnight time. So this line here, you can see here, delineates the start of true day. We call it true day. Your normal MT4 uses the 0 GMT as the beginning of the day. This line here, this blue line, represents the market open. Market open at this price here. Whenever you see this blue line, signifies the market open for the day. And the true day starts 12 a.m. New York time. And you can see how market protracted above the open before running down. So once price hits this order block, we deem market to be bullish because now institutional order flow is bullish. What you want to be doing is you want to be buying below the open of the market. So you can see how market protracted against the intended move before rallying. Now, these lines you can see here represent the Q zones, which I will explain in the next lecture I'll be giving. So do not worry about it. But just know that this line here represents the Q zones. And I'm going to be giving you the name of the indicator in order to input it in your chart so you don't have to draw it yourselves. So you can see how price protracted against the intended move, took out liquidity, happening where? In the London Q zone. and then rallied. Because now you can trust that market will buy. Because when you are seeing market, this is a 30-minute time frame. So let me just zoom it. The moment market opens at this point and starts to fall, you will think that the market wants to keep going down, because you can see that it has already hit the other block. This is the other block. This is the bullish order block in the higher time frame. So once it hits it, you can see how deep it went down. Once the market opened, this is a Wednesday. Once the market opens, you may be tricked to think that market is going to continue going down. But you can see how market came down before rallying upwards. So you can see here there's a break of structure. Market retraced before another expansion. So you want to be taking your buys below the open of the market. And the particular window of time you want to be taking this trade is called Q zone. And this is the London Q zone. So you can see how market rallied below the open of this market at this specified window of time before rallying. Okay, let's look at the next day. Because now the seasonal order flow is what? Bullish. We want to be paying our longs below the market open and at a specified Q zone. So let's look at this day again. Let me zoom out. We can see how market protracted. It didn't happen in the London Q zone, but it happened in the New York Q zone. So you can see how market protracted. So you want to be buying below the market open. Market came back down to take out liquidity, here, finding support in this bullish order block before rallying. Okay, we can see another example here. In the London Q zone, market came back down, took out liquidity, because here has formed a range. So if you draw your fib, let me draw it quickly. Here, this is the equilibrium, this is premium, this is discount. Market is at discount, taking out these lows, filling in this void. Let me just enlarge it. So you can see how market filling this void, finding support where? In this bullish order block, happening when? This Q zone, the London Q zone. And you can see how market rallied beautifully. Let's look at the next day. So you can see market here below the market open. So you want to be buying below the market open. And then you can see here again, below the market open, you want to be buying. So this protraction against intended move. So if you trade this day, you might not make a profit, because you can see how market rallied down. I said to take partials here above this high. You want to be taking your partials above high. Do not be greedy. Don't expect market to keep running and running. But whenever market takes out liquidity in short-term highs, you want to be taking your partials. Here is a good opportunity here, but market didn't get to this point. But these two highs here are good opportunities for you to take profits. And then I explained that once market does not respect order blocks in whatever time frame you are trading, you want to go to a higher time frame. So this order block here is the order block we saw in that daily time frame. That order block. So you can see that this order block was respected here, but was not respected here. So this consecutive down close candle, if you draw out your line, you can see how price found support while filling in this void that you can see here, and the market rallied. But at this point here, market rallied downwards to take liquidity below the market, running to where? The daily time frame order block. And look at how price found support at this order block before rallying upwards. So you want to be buying below the open of the market. You don't want to buy above. You get your best trades below. So you can see here, market found support in this bullish order block, taking liquidity. Then market retraced again, finding support in this bullish order block, filling in this void here. There's a fair value gap here before rallying, happening where? In the New York Q zone, below the market open. So you can see another example again. Market retraced, protracted against intended move in the London Q zone, taking liquidity below the market, and then rallied. Then the same here, you can see how market. So once you see market like this, let's take for instance, this is how market was. Let's say market opened like this. And this is the market open. And the market is at this point. You want to wait for it to go below the market for you to buy. So you can see the market went below the market. And then you may want to pair it with another block, a fair value gap, a breaker, or a run on liquidity. So what can you see here? There's actually nothing. So what you want to do is you want to use the liquidity above below the market. So you can see how market took out the liquidity here. Here, market took out liquidity, finding support in this bullish order block. So you can expect to take a long here to take your profits above the market short-term highs. So you can see how market rallied upwards. So you want to take your profit above. So this is if you are day trading or you're scalping. But if you want to swing, you can't put your stop loss here or 20 pips below the market. You have to use a higher time frame to form a trade setup. But if you are day trading, let's see how many pips this is. Let's say you took the trade below this market, below from here. Let's say you took it from here. So if you measure it, this is like this 20, 21, 20 pips. 20 pips plus, which is very, very okay for a trading day. Very okay. So it's not a matter of the pips, it's a matter of the amount you risk. It's a matter of a lot size. So imagine you are managing $1 million and then you're risking 1%. Let's say your stop loss is 20 pips below this low, 20 pips below just for safety. And then and your risk to reward ratio is 1:1. Now, if you take this trade, you get 1%. And 1% of $1 million is 100K. So that's fine. So you can see how market went below market open before rallying upwards. So you can see here again, market came below the market open before rallying upwards. So you can see this blip here. You will not want to enter the trade because it's not happening in the London Q zone. So you want to wait. So even if market is rallying like this, you want to wait. So you can see how market gave a perfect opportunity happening when the New York Q zone after taking out liquidity. You see these lows they were taking. So you can take your trade just few pips below this low or this low, and then put your stop loss like 20 or 10 pips below your entry. So you can see here just little moves below the market open and the market rallied. So you can see that buy side liquidity has been taken. Now, once buy side liquidity has been taken, you have to be careful because market tends to retrace after taking out buy side liquidity in a long position. So you can see how market rallied after taking out buy side liquidity. So you want to be taking partials, your profit. So if you enter with a 3-lot size, you want to be taking out 1 lot here or 2. Or you want to take 1.5 standard lot size from here. You can see here how market rallied downwards below the market open. Like I said before, there are many things you have to combine. You don't just want to be buying below the market open because the institutional order flow is bullish. So imagine you bought here because price has taken out liquidity that's happening in the London Q zone, or you plan to buy here because why this fair value gap has been filled. You may be taking a loss here. So you want to blend a lot of things. Like I explained, one of the reasons you should expect this is because buy side liquidity has been taken. So expect that once buy side liquidity has been taken, price tends to retrace into the price range. So you can see this huge retracement into this range here, from this low to this high, took out this liquidity. So price, let me just reduce so we can see it. You can see how price retraced into this range, finding support in this bullish order block, happening where? In the New York Q zone before rallying. Then the same happened here. After price took out liquidity, find support in this bullish order block, it created a fair value gap. So market protracted into that fair value gap, happening below the market. Let me just zoom it in so that we can see it. So you can see liquidity was taken below the market here. And the price rally breaking structure to the upside. So you can see this candle here, it broke structure to the upside. This is a short-term high. How do you know a short-term high? When the candle at the middle is higher than both candles in the left and right. So you can see this high here. So look at how market took liquidity below this low, finding support in this bullish order block here, and then rally to break structure to the upside, creating a fair value gap. So look at how market protracted downwards against the intended move to fill in this fair value gap here before rallying, happening where? Below the market opening, happening when? The New York Q zone. So I hope, let me pull it down so that we see. It's happening where? In the New York Q zone. After which market rallied, take out liquidity above this high, and above this high. So you'll be taking your partials here don't expect price to keep on going. You can see that this high was not taken. So imagine your total profit was here. Market would have run down to take you out, and then you lose the whole trade. So here we can see that there's no profitable trade here. Market retraced, and then here we can see something. This is a 1 hour order block. This is a 1 hour order block. So let me go down to a 1 hour time frame so we can see it clearly. So you can see it here. In 1 hour. So I told you that once buy sell liquidity has been taken, expect a retracement. So you can see how price, all this move here is price retracement. So price retraced and found support where this bullish order block. So this is happening where in the New York Q zone. So let's go back down to our 30-minute time frame. So you can see how market found support in the 1 hour bullish order block, taking out liquidity below the market, happening below the market open, happening when the New York Q zone before rallying. Look at how it took out liquidity above the market. So you want to be pairing your longs. So the buy stops above the market for a sell. So here, there's no any profitable trade. But then this actually provides a perfect time for swing traders. As a day trader, it won't be good for you to trade. But as a swing trader, it is very, very good. Because why? Market is retracing into a higher time frame order block. So you can see here, this 1 hour order block. Market found support and then retraced down again to find support in this 1 hour bullish order block. All this happening below the market open and then at the London close. You can see it here happening, the London close. And then we can see how market rallied. You can see the rally here. So now let's continue with our daily trades. So this day again, we can see how market protracted against the intended move and then rallied. Showing taking our profits here, here, and here. So we can see another day again, another trading day, market protracted against the intended move, finding support in this bullish order block below the market open at London Q zone. The same thing again, market protracted against intended move below the market open, London Q zone, filling in this void here, finding support in this proportion block. So this is a bullish order block. This is a proportion block. And then look at how market found support in this proportion block. Proportion block is similar to another block, but proportion block is that block you see after another block. So you can see that this is another block here. Price found support in this bullish order block, creating an order block. So this order block that has been created is a proportion block. So you can see how price is like giving fuel to the order flow. So you can see how price took liquidity fund. This is, let me just draw it out so that we can see it. You can see market filled this void here. So you can see how market found support here in this fair value gap happening below the market opening when the London Q zone. So I'm going to speed up now because of time. You can see another retracement here happening in this fair value gap when the New York Q zone. So the 4 elements is you want to be buying, taking your trade. If the institutional order flow is bullish, you want to be buying at Q zones. Then you can see here again, market, there's no profitable trade here. So there are times you can reverse. When institutional flow is bullish, there are times you can sell. And it takes a lot of skill and experience. So you can see that market has been going up for a very long time and it has taken liquidity. So there are moments when market wants to retrace. And then if you look to the left, you could see maybe another block or a fair value gap or something where market is reacting from. So you can pair this, you can take short-term trades. So you can see how market went above the market open, happening when the New York Q zone before rallying downwards. But as a new trader, you want to stick with just buying. So every day you're going to the market to buy because the institutional flow is bullish. You want to keep buying until the institutional order flow is now bearish. How do you know it is bearish? When the support levels, the institutional support levels are no longer holding price, and I mean the higher time frame. Let's say you go down to a daily time frame and then you see a market shift. What is a market shift? You can see it is a market shift, only that is happening in a 30-minute time frame. So market has been trending, and then you can see how market took liquidity above the market and then rally to break structure to the downside. So at this point here, we can see a market shift. You can see how liquidity was taken here, and then structure was broken at this point here. Here, you can see a retracement into the fair value gap before rallying downwards. So this, if you see it in a higher time frame, is one of the telltale signs that institutional order flow is bearish. It could either be for a short time before the trend upwards continues, or a change in direction of the market. And then at that point, I also mentioned is when you see that the support levels are no longer holding price. So you can see here that this created a bullish order block, but it didn't hold price. So you can look at how market started coming down. And then you can see here too, these are order blocks, but they did not hold price. This is another order block. So all this is happening in a 30-minute time frame. But if they're happening in a higher time frame, they tell you that market institutional order flow now is bearish. And then you want to take another trade setup for a sell. At this point, you want to pause and wait for price to hit a higher time frame support level. And then which happened there, I did not outline it here. And if market continues to fail when institutional flow is bullish, and you are seeing that every trade you take below the market open is failing, you want to go to a higher time frame. So once you see this, you know that market is rallying downwards to a higher time frame institutional support level. It could either be another block, a breaker, or a fair value gap. So market retraced down against intended move, and then you can see how market rallied. Market retraced, again intended move, below the market open, London rallied. The same thing here. So we can keep going on and on and on and on. You can see the same thing here. You can see the same thing here. So there are 4 things to look for a long setup. The same for also a short setup. The first is a higher time frame displacement. And then the second is intermediate term imbalance. And you want to wait for a run into discount or premium or a run on liquidity. And then you want to also pair it with a break of structure to the upside or downside. If it's for a long, you want to see a break of structure to the upside. And then if it is for a short, you want to see a break of structure to the downside. This helps solidify the trade. Then thirdly, you want to look for short-term highs and lows to pair your trades with. If it's for a long, you want to pair your longs with buy stops. If it's for a sell, you want to pair your shorts with sell stops below the market. And then lastly, you want to be taking your trade at specific Q zones, which we call the ICT zone. We have the London, the Asian, the New York, and the London close. So next lecture, I'm going to be explaining the ICT zone. And as always, I wish you all good luck and good trading.